we are going to talk about one of my favorite topics, which is boosting investor confidence in Europe. And with me to cover this topic, I have three expert and experienced investors, starting with the lady in the middle. And Foss Mal is director of the equity funds team at the EBRD, European Bank for Reconstruction and Development. I should say, an institution that has, and always reminds me, a commercial approach to investing. So it's not a policy instrument, but very much a commercial terms investor. To my immediate right, Christophe Nicolas, managing director at Alpinvest Partners, and obviously a large fund-to-fund manager. And on the far side of the panel, the man who needs no introduction today, George Anson, managing director of HarbourVest and our chairman currently for the past year and for the next few hours still. Thank you, George, for carrying the torch for the last year. I guess the background to our panel is, on the one hand, that we're coming out of a very long recession. On the other hand, the last year and a half, 2 years, start to feel like money is available again. Things are looking a little bit better. Fundraising statistics that came out earlier this year were excellent for 2013 for this industry. And if you look beyond to other capital market inflows into Europe, into European capital markets, have been net positive for the last 18 months or so. On the other hand, we just heard from our previous speaker, Dr. Pacek, basically saying, don't smile so much just yet, because in fact, the emerging markets still hold most of the good cards. So I guess maybe if I can start with you, George. Which is it? Is confidence in Europe back among overseas investors?
Well, let me make a comment first, overarching, is that the way we look at the private equity and venture capital world, and indeed I think a lot of our investors, is very simply we divide it into two buckets. One is growth and the other one is value. And within that context, I think you can certainly put the emerging markets into the growth category, as you would say venture investing as well. Europe has always been, I think, a value play. Over the last 20, 25 years, economic growth on average has never exceeded 2%. So when I wouldn't be too despondent having listened to Dr. Pacek, because this is the environment in which we've operated as private equity practitioners for several decades now and have delivered very good returns. What's changed is that in the last 3 to 4 years, we've seen a return to positive economic growth. Okay, small numbers, but it's not the economic decline that we've all had to live through. And so rather than having to fight against the headwinds of negative economic growth, declining profits, poor-ish returns from private equity, all those factors are now reversed. And on the back of that as well has been the positive cash flow that investors have been experiencing for the last 24 months. So now we've got a following wind, which is, I think, driving investor interest in European venture capital and private equity today.
Right. What about you, Christophe? What are you seeing in terms of investor interest in Europe?
I would agree with George. I mean, we certainly see increasing appetite from international investors for Europe, and that's mainly coming, obviously, from the US, in a sense that they are back. If you look at what the US was investing, the US investors were investing in private equity prior to the crisis. It was to the tune of 20 billion a year. It went down to 1 billion, I think, in 2009 or 10, so very low level. Last year, it went back up to 16. So clearly, our US investors are back, and I'll elaborate a bit later as to why they're back, but clearly it's because they see performance in their portfolio. I guess the newish investors are probably coming from Asia, and this is where I think there's been increasing amount of money or increasing appetite from our clients in those regions for Europe. And why are they interested? I think they're interested for a number of reasons. First, because I think George alluded to it, economic growth or macroeconomic growth does not necessarily mean good or bad P return investments. There is no direct correlation between GDP growth and returns. There isn't any. We've looked at this subject many times. And if you look at another way of saying it is, we were looking at some of our fund positions. We were doing our reporting a few months ago, and we were really surprised to see the number of funds where you can see that the EBITDA growth at the underlying company level over the last 2 years in European companies, so many have experienced 5, 10, 15% EBITDA growth. And when you compare that to an overall GDP growth in Europe, which has been 0 or close to 0, this is just another proof that looking at private equity investment in Europe is kind of a bottom-up exercise, and one shouldn't be too focused on the macro side. I'm not saying we should ignore it, but it doesn't tell you the full story. I think another attraction for international investors looking at Europe, especially for the US investors, is that the European market today is cheaper. We were at an AGM of one of our managers who just recently bought a company in Italy that has got leading market share, has gone through the crisis, not a cyclical business, is doing well. They bought it for 7.5 times EBITDA. The same business was bought in the US last year with a similar market position for over 11 times. So yes, I mean, Europe is growing at a slower pace, but maybe to George's point as well, this is more of the value play in Europe. Prices are cheaper. I mean, look at the stock market. I have my piece of paper here because I don't know those numbers by heart, but recently the S&P 500 was trading at 10.5 times EBITDA. Average multiples in Europe are around 8 times. So just another way of saying that assets are cheaper in Europe. Not all assets are cheaper, and it's not to say that there aren't bubbles here and there in the private equity market and some high prices are being paid. But net, I think Europe represents very good value, and I think our US or Asian investors are realizing that. And they also realize there is very little correlation in terms of PE returns between what they experience in their own country or in their own geography and what they experience in Europe. So it's also another way of saying it's a nice way to diversify your portfolio. And I think that explains why they have been, particularly in 2013, they've been back in the market here in Europe.
Very good, thank you. I want to come back to some of these points about who are the new investors and relative value between Europe and US and so on a little bit later. But before we do that, let me just bring in Anne. And you have, I guess, most of your attention turned to Central Eastern Europe and then to some emerging markets further afield. As we all know, and as we also heard from the previous speaker, a few years ago, all of the money was going to emerging markets when it felt like Europe was perhaps going to fall apart. Today, that has been reversed. Tell us about the role of Central Europe in this, in what's going on here, and what's investor appetite like in that part of the region.
So first, I'd like to sort of go back to this thing that the money used to go to emerging market, and it's now no longer going there. And I looked a little bit more in details into this, and it's true to say that in 2013 we saw a dip in the very high level of the percentage of money going into emerging market as a percentage of the global fundraising. But if you look a little bit more back, you will see that 2013 is actually back to the level of 2007 and 2008. So it gives a slightly different perspective. Then if you look at this with yet another slightly more deeply, you will see that this is to be seen as the fact that in 2013, the global fundraising numbers increased so much that, okay, the emerging market as a percentage diminished a little bit. So that gives also a different perspective. Then if you do the volume of money that went into emerging market as a percentage of the previous year fundraising, actually it hasn't dipped that much in 2013. So I thought it gives an interesting perspective, and it is to be seen probably as a conjunction of different factors, the attractiveness of these respective emerging markets, which each have their own characteristics, macro and micro, and the fundraising cycles of the different GPs. Also, obviously, the attractiveness of the US and the EU markets come and give a different light to all of this. I think the CEE market, we cannot say that we have seen an absolute wall of money, as was described earlier. I think in 2007 there was a peak in fundraising in CEE, but it hasn't been the case in the recent years that it has been in that way. I think one of the aspects of the CEE market is always people asking, is this emerging or is this emerged? And I think there is no answer to that. It depends on the perspective of the investor. What I would say, the way we look at it, is that this is, it's an expression that one of the GP who's in the room coined, and I thought it's an excellent one. These are EU markets with structural deficiencies, which still give us room for opportunity for investments, which give us potential returns. The CEE markets haven't seen a wall of money, and I believe that the funds that are raising at the moment are probably going to be very good vintages as a result. And just to give a feel in terms of historical perspective, the EBRD tracks its aggregated return figures on its entire portfolio. That is, since inception, without survivor bias, so without taking out the things that didn't go particularly well. And if you look at this track record, our returns were 18.6 net IRR, the 10 years horizon return. We feel that the 10 years is really the relevant measure to look at because that's the horizon of the asset class. So these are actually pretty good figures. They are relevant because EBRD continues to be the largest investor in this asset class in that particular region. This should eventually change. And an interesting point about these figures as well is that 68% of that is realized investments. So this is not pie in the sky valuations. These are actually realized valuation, which maybe differentiates this particular European market away from perhaps China and some of the Asian emerging markets that we've seen. So I would say CEE is a market that also needs a little bit of work to understand because the different countries provide different opportunities. But it's a very interesting one, I believe.
Thank you. Thanks. So let's just go a little bit deeper on this question of differences within Europe. And let me go back to maybe our two fund-to-fund managers. Should we be talking about confidence in Europe as a whole, or is it really different regions? What does it look like when you're in California or Tokyo and looking at Europe? Is it all the same, or do they see the differences?
Well, I mean, again, a couple of facts and figures here. The fundraising for new European funds last year, 60% of the capital came from overseas investors, mostly North America, but a growing percentage from Asia. And the year before it was 45%. So there's been continuing interest in investing in Europe from overseas. But I would say that once they make that sort of bigger picture decision to have Europe as part of their share of wallet for private equity, they then start looking more closely at where in Europe should they be investing. And without a doubt, the continuing attraction tends to be the more Northern European economies, partly because they're larger in some respects, and there seems to be more private equity activity in those marketplaces. But I think that's also their macro call in terms of where they think the better returns are likely to come from. That said, it is a risk-return equation, and I can think of several investors who are saying, well, if that's where all the money is going, then I'd rather be putting a few more investments in my portfolio that are concentrated in Spain and Italy and some of the larger southern economies as well.
Right. Christophe, anything?
I would agree. I mean, the big winners have been the pan-European funds because it's kind of a easier call to make if you're investing from very far. I think the second winners have been the Nordic funds, and to a certain extent some of the German funds, but I would say mostly Nordic funds. There's been very little money raised in France or south of France. There were very little money raised in those countries anyway, even before the crisis. But I think today it's still quite a tall order if you're in California or in Tokyo to say, I'm going to make a commitment to a Spanish country fund or Italian country fund, which is not the case for some European investors who have been in the ground for a long time and managed to distinguish between managers and do bottom-up exercise I was talking about earlier, which is, who are those interesting managers? Do they have an interesting strategy to make money going forward? And I think that is still very difficult to do. So what we see is a lot of appetite for help to help them invest, to help those US or Asian funds to help them invest in local usually country focus funds in Europe. That drives a lot of demand for our services.
Right. Okay. So let me come back to another point that was mentioned earlier by both of you, I think, and this question about Europe as a bargain market or versus growth markets. It seems that Europe has always been a sort of safe, not perhaps quite as safe a haven as the US, but it's a safe place to invest, safe legal environment. We at least used to have currencies that were safe, and investors, came to Europe not expecting great growth, but it was a safe place to keep their money. Is that still the case, or with what we heard from the previous speaker about very fast and aggressive growth from some of these Far East Asian and South American companies, is Europe going to be overrun unless it manages to create growth and become more dynamic and also play a little bit on the growth side of the ledger? What do you think?
Well, I was actually intrigued by a comment that Dr. Paszek made about emerging market companies and their interest in going global, and particularly their interest in acquiring companies in the, say, what do you call the third and fourth layer of the pyramid. And for those of you who were in Istanbul last year, you might recall the presentation done by EY, which talked about, in fact, how poor European private equity managers and their advisors are at selling their companies at enterprise values of, say, around €1 billion, because their research suggested that they tended to sell to their best-known competitors in their developed markets. And in fact, only 10% of the sample set they were measuring were actually sold to Asian and emerging market companies. And their conclusion that they drew there was that, in effect, I suppose their advisors were being a bit lazy, or they didn't have the right contact networks in those emerging economies and in Asia, where that was most likely to be greater buyer interest in those underlying companies. And so maybe the messaging that came out of that presentation is push your advisors a little harder about how you're going to market and sell your private equity investments, because there is a lot of demand coming out of Asia and emerging markets. And if they can't answer the question, why aren't you talking to buyers out there, then maybe you should be picking a different advisor. And I think that's actually a theme that carries on here. I mean, if anything, Dr. Paszek is saying, the desire to invest in Europe from overseas corporates in emerging markets and developing markets is even greater than it's ever been. And I think that's a great statistic or fact to talk to when you're talking to investors about why they should be investing in Europe, because I think the exit markets, if anything, are going to look more attractive over the coming years for private equity than they ever have in Europe.
Mm. And you were saying in your earlier remarks that CE has kind of the best of both worlds. It's within Europe, so it has the safety of the European Union, but it's also an emerging type economy. Mm-hmm. So does it really? Or on the other hand, Dr. Paszek said one of the bits of data I picked out of his stream of information was that 80% of CE companies missed their targets last year.
Yes,
So-
I was a bit puzzled by that because I don't see that in my own underlying portfolio of about 500 companies or so in that region. So I don't know. I will go back and look into this. I was a little bit intrigued. But I think the fact that these are EU countries is definitely there. If you look at the PE penetration of CEE, it's actually below sub-Saharan Africa. So you can see the opportunities. The fact that they are EU countries give political stability and a legal environment that is easy to understand with laws that are enforceable, but then you have at the same time such low PE penetration. The deal flow of the GPs in that region is still proprietary, and most of the time they buy from founders, owners, so you have the possibility to have attractive transactions. We have also not seen this massive inflation in prices, so maybe in some asset classes and maybe in some size of transactions, but the majority of this market is really a mid-market market. And the opportunities are there for those GPs who are have the capacity to look for them. So I think there is definitely possibilities. I don't know. I was intrigued also by what he was saying. I didn't fully comprehend. Maybe they don't have the right partners on the ground. I don't know.
All right, maybe there's some fact checking.
I will ask him. Yes, exactly.
Maybe just a different perspective on this. If I look at last year, our European portfolio was net cash positive, so we had more distributions than capital calls, and that's been the case for now a few years. That is not the case for our emerging market portfolio, because I guess it's, and I'm looking at and I'm comparing apple to apple in terms of vintages. So I think Europe still has a very strong card to play. The returns are there. There are cash returns. And I think the Asian story or the emerging market story, clearly, they will get there as well, but there's a level of maturity that they need to reach. Second is not, emerging market versus Europe. That's not necessarily mutually exclusive. I mean, there was a stat compiled by our mother company, Carlyle, on exports from Europe into Asia. Versus US exports into Asia. And Europe today exports around twice more goods to Asia than the US does. So Xavier Moreno explained a bit earlier that there are some mid-market funds in France that now invest in offices in those in the BRIC markets in order to help their companies to go abroad. This also what I'm saying is another way to play the emerging market card. If you are a European investor, that's a very valid way of capturing the opportunity. So I don't think suddenly that Europe has gone, not so attractive, and let's go to emerging markets where there is higher economic growth. I don't think that's the way investors are looking at it.
Very good. So if you follow the cash, Europe is doing quite well, and exporting companies is a good way to play that market as well. Let me move on to a different topic. Before I do, we'll open it up to questions in a moment. So if you have any questions, you can put up your hand and get a microphone over, and we'll take your question afterwards. We've had some changes in the investor landscape as well over since the 2008 crash of Lehman, and the investors who are coming back with money into Europe today are, I think, different than the ones that were here at the last fundraising cycles. George, you want to start and just talk about that a little bit?
Yeah, sure. Again, those of you who have seen the EVCA fundraising data will know 5 years ago, 6 years ago, for most of the EVCA's fundraising history, banks have been the largest year in, year out contributor to new fundraising. Today, that figure is as close to zero as it's going to be, and it's probably not going to change. So the largest funder for private equity funds historically is gone. And that's for structural reasons in the banking industry that we all know about. The second thing is we've got a secular shift in the pension fund market, moving from DB to DC, particularly in the United States market where it's most keenly felt. And yet, they still have the same investment return desires as they would, say, managing a DB scheme. But the typical fund structure, the limited partnership, probably isn't best suited for that particular type of investor. Again, pension funds have been one of the largest funders of private equity and venture capital funds over the years. So you're looking at about a 50% shift in your customer marketplace. The good thing is that we've seen more new entrants into the marketplace, particularly sovereign wealth funds, either investing directly or through advisors and gatekeepers to sort of redress the balance here. I think part of the papering over that's happened, though, in the last couple of years is what Christoph said earlier, is that the cash flows for many of our underlying investors has now suddenly gone remarkably positive, and they're underallocated. We actually have the reverse denominator effect playing on our clients. So not only are they now getting positive cash flow returns from their private equity and venture capital investments after a pretty long barren patch, but the overall size of their plans has grown as the stock markets and equity markets have grown as well. So we've had this multiplier effect where They want to be at a 3% target. 3 years ago, they were at 4%, not committing anything to private equity. Now suddenly they're at 2%, and they've got to play catch up. So where do we invest, and what looks interesting? I think, fortunately, Europe, still looks very attractive from the value proposition, the fact that their European GPs are performing well. And interestingly enough, in the past 12 months, venture investment has been one of the star performers almost on a global basis, Asia, the US, and Europe as well.
You mentioned European GPs are performing well. How has this asset class in Europe really done through the crisis? Are the results starting to come in on how we've done relative to other asset classes?
Well, and that's the point, is relative here. You can't look at what happened 20 years ago and pat yourself on the back. It's all about what's happened in the last 5-10 years with interest rates at all-time lows, inflation still relatively subdued, the stock market's just sort of improved, but on the longer term they're pretty flat. Private equity looks pretty darn good on a relative basis. But again, going forward here, I think it's all about managing expectations for institutional investors, and I think it's a pretty brave man or woman who would sit in front of their investors and say, it's going to be like it was 20 years ago. I just don't think that's the case. I tend to turn it around and ask them first, what do they think the public markets are going to do over the next 5 to 10 years? And I calibrate my response on private equity based on that.
So, Anne, what do your investors expect from their investments in terms of returns with you?
Well, the investors into EBRD are countries, so they definitely expect a return, and we totally contribute to that, the equity part. The investors that we try to mobilize into the funds in which we invest in our region expect returns higher because they see it often as an emerging market. So it's, back to what we were saying earlier, is it emerging, is it emerge? It's a bit of both. But I would say in terms of the investor composition, we're starting to see in our region more sovereign wealth fund and also resurgence of family offices. There's more and more family offices who are looking at investing in these mid-market GPs investing in Central and Eastern Europe, which is a very interesting thing. Their assessment is that there are interesting opportunities there, and obviously we share their view and we hope we're right. So.
Christophe, do you have a clear idea of investor expectations, emerging markets versus Europe? And
I don't think people expect different returns. I'm not saying they should, but I don't think they do expect different returns between emerging markets and Europe and the US. It certainly hasn't been our experience. Our performance between our European portfolio and US portfolio is very similar.
So are you saying there's no risk weighting that goes on between emerging markets and?
It doesn't seem to be any evidence around that. I think the performance on the emerging market portfolio is very good on a TVPI basis. DPI, a better DPI would be welcome, and I'm sure the next few years will show us that this is the case. But I just want to go back to what George was saying earlier about the changing landscape among LPs with the increasing share coming from the US and Asia. I think it's a real challenge it's not really a challenge for the pan-European funds because they have large investor relations team. They've raised money in those countries anyway before. I think it's more of a challenge for the mid-market funds because if you were a country-focused fund and you used to raise money a lot from local banks or local insurance companies, it's a very different game now to say, well, okay, I need to raise 500 million. Should I go to the US? Should I go to Asia? Or am I wasting my time? Should I go pan-European? And I think for some of the existing managers, some of them have absolutely no experience of raising money or even selling their story abroad. And I think this is where I can see like a real gap in the market, where these, those investors that are sitting outside Europe get access to those good names that are not necessarily going on their radar screen, and for those local managers to find the right skills in order to access those LPs. I think that's where, in the next few years, a lot of energy will be spent getting at the learning curve.
Right, so with 60% of all the money raised coming from outside of Europe, what advice, I guess, can you give to GPs that don't have a history of relationships with overseas LPs? How do they go about
get a
building
better
this?
website? Well, no, it's kind of it's a glib comment, but I would say actually there's a lot of GPs who could do a better job with the way in which they project themselves out in a social presence. I mean, it sort of runs counterculture to some of the remarks earlier about being discreet and with the people they invest with in the family offices. But you've got to strike a balance and let people know what business you're in and the fact that how successful you've been, the transparency around your partners, and how you contact them. There are some GPs who don't put a phone number or a email address there, how to contact them. I mean, they're not helping themselves, I think, in that regard.
Right. Let me see if there are any questions or comments, any contributions.
It's Jolanda Baldek from Private Equity International. I just wondered really, you seem quite optimistic about investing in Europe, and I just wondered, what are your main concerns for the region?
Well, I'll start because we actually talked about this. And I think the prior panel that was up here before, how can I put it? I think governmental and political meddling in the investment landscape for venture capital and private equity can often have the opposite intended effect. Increasing burden on reporting for managers, higher taxation rates, which will stifle entrepreneurial creativity. Probably won't, they won't do much to help the private equity world as much as they would like. I mean, this is balancing the fiscal needs and desires of countries that are running, budget deficits and other things. But, if I had a headline, I'd say, if government can stay out of the way and let the private equity and venture capitalists and the entrepreneurs do their job, I think that would be a really good thing.
Any other thoughts?
In my markets, I would wish to encourage the local governments to change regulations to allow the local pension funds to invest in the asset class. That would be my wish number one.
I would say we need a stable regulatory and tax environment and legal framework. I think each time big ideas come that may or not be implemented, that just freezes particularly non-US LPs and non-European LPs, from investing into Europe. So offering a stable environment, hopefully a stable currency, will help. Will go a long way in helping that.
So let me, before we take another question, let me just follow up on this with one question of my own. Why should governments care about private equity's ability to raise money overseas? Why should Europe? Why should our European governments care about the ability of some capitalists to raise money from overseas investors?
I think if you look at the stats, so private equity is very active. Most of the private equity world is investing with medium-sized companies, SMEs, and SMEs are the lifeblood of all European economies. Some economies more than others, but we computed that around 70% of employment in Europe is driven by SMEs, and SMEs need capital in order to grow, in order to provide jobs to people that are secure, and that capital today is really not available from the traditional banks, or if it is available, usually it's at a very high cost. We look at interest rates recently for a small business was around, these guys were paying 7 to 8% cost of debt, and that's probably twice what a large business would pay. So there's a real funding availability and funding cost issue for SMEs, and I think that's where private equity has a role to play. My perception, and this is probably, I probably give a lot of credit to the EVCA and the various local venture capital associations. I think most of the governments now realize that private equity is actually a force for good, for putting money, providing finance to those SMEs that provide jobs to people. I think that's the number one priority.
All right. So, sorry, did you want to?
Well,
had
I
something?
just wanted to say, the transformative impact of the private equity firm is just enormous. You know, the SME, they would take a company which doesn't even have transparent, maybe accounting and everything, and then after being in the hands of the GP, they're becoming an institutional platform that has accounting, is fully transparent, pay taxes, counts its employees, etc. So I think that's a very positive thing, which definitely seconds the fact that the regional VCAs and the EVCA help to understand that better. Very important.
Right. So staying on the topic of the impact of regulation on our ability to raise funds, I guess we're almost a year into the implementation of AIFMD. I guess it's too early to say, you know, what impact it is having. But are there some early indications? Is it overall good for fundraising? Is it bad for fundraising? What are your thoughts on the impact of AIFMD on European GPs' ability to raise funds?
Look, I think the AIFMD, don't get me wrong from my earlier comment, I think, you know, for the size industry globally that private equity is $3.5 trillion, it's only right that regulation should come into the private equity and venture capital investment class. But it should be fair and it should be proportionate. And AIFMD, as you know, also encompasses the activities of hedge funds and other alternative providers. So, you know, how applicable AIFMD is, I think we are where we are. It's sort of almost feels like a one-size-fits-all type of jacket and doesn't feel very comfortable in the private equity world. How it's impacted the fundraising, I think it's too early to tell, to be honest. What I would say is that it should, for European institutional investors, probably restricted their choice of being able to invest in non-EU based GPs. Because those GPs outside the EU are not going to be marketing to them going forward here. So if they've got an allocation to fill, which, believe it or not, is what the way a lot of them think about private equity investing, they may be restricted to investing at home. So I think actually for domestic European general partners, raising capital from local institutions, pension funds should be easier.
So there's a bit of a hidden nationalism, or
in certain countries, I think that's exactly the way they've approached the AIFMD and its national implementation. Yeah.
Any other views on this question? Or all right. Any other questions or contributions from the audience at this time? All right. Well, we started a little bit late, so I think we can probably take just a few more minutes to wrap up. I guess I would maybe ask each of you as a sort of final question: what should this industry do, and maybe some advice to EVCA, if you will, to continue for us to continue to attract overseas investment into Europe in a world that's increasingly competitive, increasingly global, and with lots of fast-growing opportunities in other parts of the world? What should we do? Maybe Christoph, do you want to kick that one off?
I think, you know, maybe going back to the point about the relationship between governments and the PE industry in Europe, I think every time our industry, our PE industry, is able to demonstrate its positive role on job creation and job security, on its contribution to tax payments from the employees, from the companies. I think each time we're able to make that case, we'll probably make the governments understand that this is a really important asset class. This is not just a bunch of people who speculate on companies, but that actually it creates economic growth and economic stability. So I think for us as an industry, we should have a relentless effort at making our case, both at the European level, but also at the local government level, in terms of our contribution there. I think each time we do that, we're going to be helped.
Right. And?
I think it's difficult to add anything else because I think he said everything already, but I think that's exactly right. So increase the visibility of all the positive things that come out of private equity activity one way or another is definitely fundamental, and I think that's EVCA is doing a great job with this, and it's continuing this is very important job.
Let me just throw a last-minute curveball to George then.
Mm-hmm.
What we heard here is really about what the industry can do to be accepted and to be, but do overseas investors care that we look good with our governments and have favorable policy and so on? Or do they just want returns?
Well, let's kind of flip it around. You know, if you increase government regulation, bureaucracy, make it harder for the entrepreneurs and the managers to do their job and get to the ultimate outcome of good returns, then they might say, you know, this is too difficult. You know, we'll go somewhere else where the activities, the free market activities, are embraced by government and regulation. So, you know, here, yes, as I said before, regulation is part and parcel now of the landscape we operate in. But let's be really careful not to overdo it, because you may be killing or suppressing an industry, which I think, we talked about it a little earlier, you know, I think really punches above its weight. And if you think, when the people I talk to at our asset allocators at big pension funds and everything, the most interesting thing they like talking about across all their asset classes is what's going on in venture capital and private equity, because for them it's real. They shop in some of the stores that I mentioned earlier. They use the apps. You know, for them, they get it. And what's really intriguing about it is the corporate governance model, because they know that the people who own these businesses are directing the future for them. And actually, so as a corporate governance model, it's the poster child, you know, for what they're looking for within their internal committees, you know, what private equity does. So I think, you know, that it really got a lot going for it. And I think that, you know, we could always do more to promote that.
Great. Well, thank you, panel, for restoring the confidence of any who might have flagged after listening to the prior speaker. Thank you so much. And I think that draws it to a close.